My name is Corey Hulstein. I'm a tax director here at Modern Wealth Management and also a CPA. Today we're going to be talking about gifting and taxes. What do you need to know? When we talk about gifting and taxation, there's really two different types of gifting that we're going to discuss today. The first one being charitable donation strategies. The second one being how do we transfer wealth to the next generation within our families. The first section here is charitable donation strategies. Now, we've produced a lot of varying content on this particular topic, so feel free to check out a lot of those other videos. Today is going to be a quick high-level view of charitable donation strategies. When we talk about charitable donation strategies, we're really thinking about two different age groups of people. The first being those who are under the age of 70 and a half. Those who are under the age of 70 and a half have limited charitable donation strategies because they are going to still be subject to the standard deduction rules when giving to charity. When we're looking at people who are under that age 70 and a half category, we're really looking at things like, does a donor advised fund make sense for me? Should I gift appreciated stock? Do I look at grouping several years of donations together in order to eclipse that standard deduction? Those are all personal questions that you're going to have to ask yourself when dictating how do I make this donation as tax efficiently as possible? So again, as a reminder, because of the Tax Cuts and Jobs Act, we are looking at this high standard deduction and also this SALT cap on our state and local taxes paid. With the combination of those two items, I tell a lot of people that charitable donation strategies really start coming into play when we're looking at around $10,000 to $20,000 of donations in a single year. Now, when we talk about things like donor advised funds or gifting appreciated stock, those are going to be specific questions related to your income and your standard deduction threshold. Work with a CPA, work with your financial planner to dictate whether those are going to be applicable strategies for you. When we look at appreciated stock, this is going to be a theme both on the donation to charity and also from a wealth transfer standpoint. The highlight here is if we have stock that has appreciated in value, most times it's going to be better to gift the stock outright to the charity or to the next generation, as opposed to selling the stock first and taking the cash and sending that to either the charity or the family member. When we're talking about stock that has declined in value, there we're looking to capture the tax deduction from the loss. So in either case, it's likely going to make sense for the person who is gifting the cash to liquidate the stock first, claim the tax deduction on their return before sending the proceeds to either the charity or the family member. The second group of people that we talked about when it comes to age ranges is those who are over the age of 70 and a half. The reason I divided the people into two different camps here is because once we reach the age of 70 and a half, we are now able to unlock the Qualified Charitable Distribution Strategy, or QCD for short. In essence, what we're doing with a QCD is we're taking money that has been stored in our IRA account. This money has never been taxed. It's grown tax-free. This is a tax-deferred account. What we are doing is we are taking money directly from the IRA account and sending it directly to the charity of our choice. The key note here is family members are not a charity. We must have a 501c3 registered with the IRS in order for this transaction to qualify. And the other takeaway here is we don't want to touch the cash in the middle. The key is that the money goes directly from the IRA account directly to the charity of our choice. The benefit here is money left our IRA account, which has never been taxed, and as long as the tax return is filed appropriately, that is not a taxable event in the IRS's perspective. You will not also claim that deduction as a donation on your return. It simply just never shows up as income on the tax return. The heart of this video was not meant towards charitable gifting strategies, but we have a ton of other content. Feel free to check it out if you have any other questions on that topic. The main content for today is really meant to say, how do we transfer wealth to the next generation? And oftentimes that comes through the form of gifting to family members. The IRS has several guidances on this particular topic, and the main one for you today to know is we can gift $19,000 in the tax year of 2025 before we really have to do anything. Now, the key here is that $19,000 limit does scale with inflation. So if we're watching this video at a future time, that number might scale up to 20 or 21,000 over the next couple of years here. When we talk about this $19,000 limit for 2025, the key to note here is that is per person, per beneficiary. So for example, I've got 2 children at home. Let's say I want to give child 1 $19,000 this year. I also am able to gift child number 2 $19,000 before any type of tax filing is required. Now let's add another layer here. If I am married and my spouse also wants to give each child $19,000, that is deemed acceptable by the IRS without filing any type of tax or forms reporting the transaction. Therefore, I can gift any individual with my spouse $38,000 in 2025 before any type of tax filing is required. What I often recommend for married couples who are gifting over the $19,000 to any individual and staying under that $38,000 cap is I recommend writing separate checks and noting in the memo very clearly who is gifting the asset to which individual. Not that it would likely become a problem with the IRS, but adding that extra layer of security tells the story a little bit cleaner than something like a $38,000 check to another individual. The next question I would likely get in this scenario is, well, what if I want to give one child $50,000 this year for a down payment on their home? What is the course of action we should take at that point? Once we have eclipsed that $19,000 for a single person or $38,000 for the married couple to any particular individual, then we are starting to look at a tax filing required reporting the gifting to the other individual. To report that transaction, you do so on Form 709. And basically what that form is trying to do is track how much you've gifted in the year to an individual versus what that standard limit is. In this case, let's say wife and I are giving $50,000 to one child. My wife and I can give $38,000 to that one child without reporting any transaction. The difference here being the extra $12,000 we gave. Form 709 is going to track that and say, what do we want to do with that extra $12,000? And now we have a couple of choices at hand. Choice number 1 is we can apply the $12,000 essentially against their estate exemption. Now, what that means is today, the estate exemption per person is $13.99 million for tax year 2025. This number does scale with inflation, and there's some other things we'll talk about there. But for example purposes, if you are married filing jointly, you can transfer $28 million roughly to the next generation before the IRS really cares. That $12,000 that we gave this year will offset against the $14 million single limit or $28 million married filing joint limit when transferring wealth after our passing. In that scenario, if that is the option we elect, there is no taxes due upon the gifting in 2025. The $12,000 offsets against the $14 million, and our lifetime exemption is reduced permanently by that $12,000 gift. Option number 2 is you can make an election on the Form 709, in essence, to tax the gift today, but you would only do so knowing that if your estate exemption is going to be null and void in the future. What I mean by that is if our estate today is worth $50 million and the gifting that we are making today is not necessarily towards a family member that we care about tax efficiency, you can elect to have the recipient claim that income themselves and pay the taxes on the funds they received over and above the gifting limitation. The thing to note here is when it comes to gifting and when it comes to assets over the estate exemption, these do come at a high cost. Now, when it comes to gifting during our lifetime, this estate exemption can run from 18 to 40% in taxation. When it comes to assets transferring after our lifetime, a lot of those funds are going to be taxed towards these 30 to 40% tax rates for any assets over the estate exemption. Everything that we're discussing here so far is really related to the federal taxation of gifting. It's important for you to understand and know what your state dictates for their own estate exemptions as well, as varying states will have their own estate taxation issues. Everything we've talked about is gifting today during our lifetime. There are other ways around the estate tax issues during our lifetimes if we are not trying to gift the cash today. What I mean by that is for a person with let's say $50 million of assets today, knowing they will likely fight this estate taxation issues in the future, there are some strategies on transferring the assets towards what we would call an irrevocable trust today. Irrevocable trust can come in many shapes and sizes. The most common one that we're going to see today is what we call an ILIT, or an irrevocable life insurance trust. And in essence, what we are trying to do is shift assets out of our personal names today and move them to an irrevocable trust. Irrevocable trusts are their own entity when it comes to taxation. They will have their own tax ID number, they will have their own separate tax filings, but there are some trade-offs when it comes to irrevocable trusts. And oftentimes when I'm talking to clients about irrevocable trust, it boils down to two things: tax efficiency versus control of the assets upon your passing. An irrevocable trust can create tax efficiency when it comes to wealth transfer. So again, for that person who is going to be over the estate exemption, it might make sense to make a gift to the irrevocable trust today. Those assets will appreciate over time, but they will be sheltered from the estate exemption at that point. Remember what I said, an irrevocable trust is its own tax entity, meaning it is not subject to what exists in your current estate. It is a separate asset outside of the estate. So if we have an asset that is highly appreciating over time, it might make sense for us to gift that asset to the irrevocable trust today, filing the Form 709, reporting that gift, and letting that asset appreciate over time outside of your exemption. However, the trade-off here is irrevocable trusts need to have some element of control. It has to dictate when the recipients are able to access the asset, which may cause some tax inefficiencies later in time. The trust tax rates are going to be significantly higher than an individual tax rate for most people. So that would be one thing we'd want to consider when setting up this irrevocable trust. The other consideration we would want to make in this scenario is upon our passing, our personal assets do receive a step up in basis. Since an irrevocable trust is a separate tax identity and it does not pass away, the assets that are placed inside of the irrevocable trust will not receive a step up in basis upon your passing. When it comes to irrevocable trust, the main thing to consider here is, will we exceed the estate exemption during our lifetime where these assets now are going to be taxed at an estate level? Remember what I said, 30 to 40% taxation is what we're looking at for the assets that exceed that threshold of the estate exemption. One last note regarding the estate exemption. Today, that estate limit is $13.99 million per person. However, that number does scale with inflation, meaning it will continue to grow, but we are currently at a flux when it comes to taxation. With the Tax Cuts and Jobs Act, the estate exemption was greatly increased during this time period. If we see the sunset of the Tax Cuts and Jobs Act take effect in 2026, that estate exemption is set to be cut approximately by 50%. With a 50% cut to the estate exemption, that will open up a larger group of people who may need to consider these different strategies. We talked a little bit about Form 709. Form 709 can be used to report a gift on any given year, but there is one more useful case for Form 709. For a married couple, it may make sense to file Form 709 after the passing of a spouse. With the passing of a spouse, assuming the remaining spouse will inherit all of the assets from the deceased spouse, the IRS does not view that as a wealth transfer event. Those items were accumulated together as a married couple. However, when one spouse passes away, their exemption passes away with the spouse. So one thing we may consider doing is filing Form 709 after the passing of the spouse in order to claim portability. Portability is a relatively new concept in the tax code, but in essence, what portability is saying, my spouse passed away, their exemption was approximately $14 million today. Because the assets transferred to me, there is no estate tax issues. However, when I pass away, I would like to also claim my spouse's $14 million exemption, meaning my exemption is now approximately $28 million. If the Form 709 is not filed after the first spouse's passing, that exemption is lost. So it is important to file this Form 709 upon the passing, especially for those higher net worth people who may be subject to these estate exemption rules. So I know we've talked about some fairly complicated tax issues today, so here's a quick summary of everything we've discussed. Charitable donation strategies. Make sure you're aware of your age and also what the standard deduction is for you. Try to capture as much value through donor advised fund or appreciated stock in order to capture the value of that donation on any given year. When it comes to wealth transfer, be aware of the federal estate exemption, but also be aware of your own state's estate tax exemption. If we are in a situation where we look like we will eclipse that exemption, we may want to consider strategies like an irrevocable trust to shelter the assets from estate taxation. Additionally, be aware of the federal gifting limitations each year. Structure your gifting in a way that makes sense to fit under that cap. In that case, we no longer have any type of filing requirements on any year of gifting. Thank you for watching today. My name is Corey Hulstein, Tax Director and CPA here at Modern Wealth Management. If you have any questions regarding this topic, feel free to reach out to us directly. If you enjoyed this video, please like, share, and subscribe.
The views expressed represent the opinion of Modern Wealth Management, LLC, an SEC-registered investment advisor. Information provided is for illustrative purposes only and does not constitute investment tax or legal advice. Modern Wealth Management does not accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action.